Do you ever want to start investing, but you just feel like the stock market is way too complicated? Like it's some exclusive club with this completely foreign language that's literally just designed to keep you out? Well, look, you are absolutely not alone. The financial world, they love their jargon. But in this explainer, we're going to break it all down for you in very simple language. We're going to strip away all that noise so you can actually start investing the smart way and, do it without losing your mind in the process.
Welcome to Wealth Forge, where we help you build a stronger financial future. If you enjoy practical financial education, please like this explainer, subscribe to Wealth Forge, and share it with someone who wants to improve their financial future. Okay, let's dive into this. Here is our roadmap for demystifying the market so you can build wealth. We'll quickly cover decoding the stock market, stocks versus ETFs, investing versus trading, smart strategies for beginners, and finally, avoiding common mistakes.
First up, Section 1, Decoding the Stock Market. What exactly is it?
So, at its core, the stock market is simply a marketplace where buyers and sellers trade ownership, which we call shares, in public companies. That is literally all it is. Think of it kind of like a massive digital farmer's market. But instead of buying, a basket of apples or tomatoes, you're buying a tiny slice of the actual companies that you probably interact with every single day. If you buy a share, you are an owner of that business, plain and simple. It really isn't this scary, untouchable casino. It's just an open marketplace designed for exchange.
Moving right along to Section 2, Stocks versus ETFs, and understanding your choices.
Let's compare your two main investment options here. First, we've got stocks. As we just established, buying a stock means you're buying ownership in a single specific company. If that one company has a great year, awesome, you do really well. But if it struggles, well, your investment takes a direct hit. Then on the other hand, we have ETFs, which stands for exchange-traded funds. Think of an ETF as a bundle or a collection of many different companies grouped together. To put it in everyday terms, buying a single stock is kind of like buying one giant bag of a very specific flavor of potato chip. If you end up hating it or it goes stale, you're out of luck. An ETF, on the other hand, is like buying the ultimate variety pack of all your favorite snacks. If one flavor isn't doing great, you've still got dozens or even hundreds of others balancing it out. And for beginners, that variety pack is almost always a much safer and smoother ride.
Which brings us to Section 3, and a really crucial distinction: investing versus trading.
You see, the financial media mixes these two concepts up all the time. But investing is all about a long-term focus and steady wealth building. It's the act of planting a financial seed and then patiently letting it grow into a strong tree over years or even decades. Then, on the flip side, we have trading. This has a very short-term focus, and it is a high-risk activity. Traders are actively trying to jump in and out of the market, basically trying to guess daily price movements just to make a quick buck. So the crucial takeaway here is that beginners should focus entirely on long-term investing. Steering completely clear of the high-risk, stressful nature of trading is exactly how you protect your hard-earned money and, honestly, your peace of mind.
All right, on to Section 4, Smart Strategies for Beginners and How to Begin the Right Way. Before we even talk strategy, we have to address the elephant in the room. How much money does a beginner actually need to start? Because there is this massive, widespread misconception out there that you need a huge pile of cash, like thousands or tens of thousands of dollars, just to get your foot in the door of the stock market.
But the real answer? $50. Seriously, $50. You absolutely do not need a fortune to begin building wealth. Because of modern technology and zero-commission platforms these days, you can buy what are called fractional shares, which literally means buying just a tiny slice of a share if you can't afford a whole one. So you can invest in massive companies or those ETF variety packs for the cost of a mediocre takeout dinner. The barrier to entry has literally never been lower. The most important thing isn't the giant sum of money you start with, it's the simple fact that you actually start.
And the real secret weapon here is a concept called dollar cost averaging, or DCA for short. It is simply the strategy of consistently investing a fixed amount of money at regular intervals, completely regardless of what the market is doing. Ups, downs, doesn't matter. Let's say you take that $50 we just talked about and you invest it on the first of every single month. By automating this, you end up buying more shares automatically when market prices are low and fewer shares when prices are high. It takes all the guesswork and all the emotion right out of the equation. This really proves that consistency matters so much more than perfectly timing the market.
And what's so brilliantly illustrated here is how consistent investing over several years creates this incredibly powerful snowball effect. In year one, you're just planting the seeds, so the growth looks a little modest. But by year 3, your consistent dollar cost averaging really starts to show some actual compound growth. And by year 5, your portfolio is noticeably larger. And it's not because you got incredibly lucky on one secret stock. It's because you were patient and you were consistent. It is the snowball effect in action, building real wealth over time.
Finally, Section 5. Avoiding common mistakes and navigating the pitfalls.
Because even with a great strategy, there are big traps that trip up a lot of novices. First on the list, chasing hot stocks. Listen, beginners absolutely shouldn't chase hot stocks, because by the time you hear everybody talking about a company on social media or at a weekend barbecue, the easy money has already been made. You usually end up buying at the absolute highest price out of this fear of missing out, and then you just sell out of panic when the hype inevitably crashes. The other massive mistakes? Letting emotions like fear and greed drive your financial decisions and completely ignoring your long-term goals the second the market hits a bumpy patch.
So, how do we actually defend against those mistakes? We use risk management. Number 1, diversify your investments. Remember our ETF variety pack analogy from earlier? Just don't put all your eggs in one single basket. If you own a diverse bundle of companies, a single bad day for one business isn't going to derail your entire future. And number 2, stick to your long-term plan. If the financial news is making you anxious, just turn it off. Diversification and unwavering patience form the ultimate defense for a beginner's portfolio.
Which brings us to the end of our explainer, and I have a really vital question for you to answer right now. What is the very first step you will take today on your own financial journey? Are you going to look at your budget and find that first $50? Will you go research your very first ETF? The market rewards those who take action and remain consistent. If you enjoyed practical financial education, please like this explainer, subscribe to Wealth Forge, and share it with someone who wants to improve their financial future. Keep learning, stay disciplined, and start forging your wealth today.